We're live. What is going on?
What's up, everybody?
What's going on, everybody?
Hope everybody had a great Valentine's Day.
Yeah, happy Valentine's Day to everybody. Hope you all are going to spend a little bit of your V-Day tuned in to talk about mortgages. One second, make sure that we don't get bothered here.
We apologize to all significant others for distracting, taking some time away.
Yeah, let's wait for a few people to get on here. Today, we are going to be touching on CMHC versus uninsured commercial refinances. Benefits, disadvantages, why somebody would use it, why somebody wouldn't use it, repurposing a property, and some of the limitations behind it. When we were doing a little bit of research on this, when we work with our clients on this, it's a very liquid landscape. Things are always changing. So we thought that we would create a video, which launched on Friday, to outline what that looks like.
Yeah, last year, I think in July it was, CMHC made some changes to their regulations around their commercial refinances and, what the allowance was for equity takeouts and just some of the changes that have been made and how that's going to affect the investors moving forward. We've had a lot of people starting to get into the commercial investment space and the larger multi-residential commercial space. A lot of them are looking at the undervalued properties and looking to do the larger burrs. So we just wanted to make sure everybody knew what the potential outcomes were for the refinance, whether you were looking to take that equity out and pocket it, or whether you were looking to take that equity out and purchase another building. What are you looking at in terms of what you can do with that equity? What are the loan to value differences? What are the amortization differences? And how does that affect your cash flow moving forward?
Yeah, guys. So if you guys have any questions specifically about the commercial refinancing process, drop them in below, or where if you're on YouTube, just below as well. We'll get to all your questions. Maybe halfway through, we'll stop, answer the questions, and then continue with what we're doing. What's going on, everybody? Thanks for joining. I guess we can get right into it. So, there's a handful of advantages of taking an insured mortgage product. As many of you know, CMHC insurance specifically is there for people who have less than 20% down for the residential mortgages. That CMHC insurance is mortgage default insurance. Essentially what happens is the lender takes on zero risk when CMHC insures a building or a property. What happens is the client takes on the overall cost. They pay the premium, and then the insurance covers the property in case a lender or borrower was to default on the loan. This works for commercial properties as well and multifamily properties. So essentially what happens is CMHC will allow you to purchase a commercial property up to 85% loan to value, which is significantly less down payment than what a conventional lender would allow you to do.
Yeah, you're saving at least 10%. The typical conventional down payment, 75% loan to value. So, that extra 10% definitely helps with capital, keeping that capital back in your pocket and being able to put that, towards renovations or another purchase. The majority of the investors that we work with probably aren't going to be purchasing directly into CMHC. And it's for a couple of reasons. The big one is just the wait time right now for CMHC. It's about 12 to 16 weeks just for the application process. So the majority of the buildings that we see close within a 2-month timeline. So it doesn't fit the timeline to be able to close that quick.
Yeah, you're definitely going to want to have some sort of flexible seller. Like if you want to put yourself in a situation where you're going to be taking on a CMHC loan, you're going to want to ensure that your seller is on the same page as you, just because of the process and how long it takes to be able to complete the application.
Yeah, guys. Right now, I think a commercial refinance or a commercial appraisal, in the KW Guelph area, just from what we've been quoted, is at least probably 4 weeks right now. You're probably looking at a whole month to get an appraisal back. And then you need time for the lender to take a look and review that and make sure they're all good with the appraisal and everything comes in on value. So, we definitely need, any sort of condition of financing or conditions in the purchase and sale. you're going to need at least a month to be able to get the correct documents in and be able to make that decision thoroughly and having the right information to make that decision. The second reason why most people probably aren't buying a building under CMHC is just because a lot of the investors are buying an uninsured building at a lower cap rate. The specific reason investors are looking at this, and then you guys know, but what that they're looking to be able to create that uplift and take out a larger equity takeout than you would get on the residential side. So the majority of these buildings just aren't at the right level to be insured with CMHC as a purchase. Most of them are going in through some sort of credit union or even a private lender at that point to be able to get it done. So
to squeeze it in. Yeah, there is we talked about it in a video that's about to be released, but essentially there are a handful of different pieces of capital that you would use throughout the process. And it really depends on where you're at and what you're looking to do. But, hey, Matt, what's going on? Essentially, the CMHC financing is for a perfectly cash flowing building. Like at the end of the day, you want a CMHC loan to be able to take advantage of the low carrying cost on a building to maximize cash flow. So if the majority of the time, as Aaron said, if you're looking to get into a building to create that value add and pull the cash out, CMHC isn't going to be something that you're going to be looking at right away, but it is a tool down the road that you're going to want to use. Specifically, what was it? May 28th, CMHC came out and said that they were going to change some restrictions in regards to how their equity takeout was going to work. They did that for a handful of reasons. They said, COVID was one of them, and the second being they wanted to increase CMHC's mandate or reinforce CMHC's mandate to support housing affordability and availability for Canadians. So what they did was they were able to change their equity takeout rules. So you can no longer use cash out refinances on a multifamily property to pay out a partner. So if you have a JV partner and you're looking to take cash out, CMHC isn't going to allow you to do that. They will allow you, though, to be able to use the capital for renovations, as long as the renovations are completed. And they're going to allow you to use the capital to buy additional properties, which then again is a cycle of creating more affordable housing for people who need to rent.
Yeah, and just to clarify on what type of property this can be used for, anything that you're looking to purchase with the equity has to be a multifamily. So it can't be a single family or a single unit. It has to be at least two. And any buildings that you're going to be renovating from the proceeds, again, has to be a 2-unit or greater type of multifamily. And you can't use that equity takeout to back pay any renovations. So if you wanted to renovate a building and you did it with cash and then wanted to use that refinance to, essentially cover the cost, they won't allow you. You have to do that refinance first, take the equity out, show them the renovation budget, show them what it's going to be used for, and then go from there.
For sure. So when we look at debt service coverage ratio and how CMHC is going to fully assess how much money they're willing to give you or qualify you for the loan, it actually changes depending on units. So, for example, a residential space, a multifamily residential space, a 5 or 6 unit on a purchase, the debt service coverage ratio is 1.1, but on a refinance, it's 1.2. So it's a little bit higher on the refi than the purchase. 7 units and up on the residential side, you're looking at 1.2 for a purchase and 1.3 for a refinance. 1.2 for 10 years and up, and the term 10 years and lower, 1.3. Now, non-residential space on rental properties, 5 units and up, you're looking at 1.4 DSCR for 10 plus years and 1.5 for less than 10 years. So obviously your choice as to how long you want to take the term for is going to change what your total qualification is going to be on the building, which is probably something that's really important. Now, CMHC obviously changes their debt servicing requirements because they want you to take a longer term.
Yeah, exactly. And I mean, how that plays out in the long term, obviously CMHC has super competitive rates. I think the average CMHC or the range of a CMHC insured product right now on the commercial side is anywhere from, I think it's like 1.2% up to 2.5%. And they have the ability to do a 40-year amortization, which is pretty huge when it comes to reducing your monthly payment and being able to increase your cash flow. So that's definitely one of the bonuses of having that CMHC insured loan and helping with the cash flow that way, and then obviously a major attraction. And when it comes to qualifying for CMHC, you don't apply directly to CMHC. We have to do that through a financial institution, and there are specific institutions that have the ability to apply in through the CMHC insured financing. Now, with the restrictions and not being able to just take that equity out, if you are looking to purchase or have renovations done on a building, we do need to have those documents up front. There is no real timeline, as stated by CMHC, as to how soon after a purchase has to be done, but they're not looking for they're not looking for something 5 months out. They want it to be relatively immediately. And what they're probably going to look for, and what they will look for, is to have a purchase and sale in hand, or some renovation costs in hand, ready to go. They're not going to initiate the process and then just have the funds kind of sitting there. They want that stuff ready to go and to have proof as to what the funds are going to be used for. Yeah, Amanda, actually, you had a question. Can you just explain a little bit? You said, can it be in a different corporation? Like, can the refinance be in a different corporation? If you just want to explain that, we'll touch on that. One of the cool advantages of CMHC is something that most people don't know, but it's called limited recourse. So if your loan does not exceed 65% loan to value, CMHC and the approved lenders may request the loan be considered non-recourse to the borrower, meaning that if something were to happen and say you were to default on the loan, the lender would only have recourse on the specific building and any asset that was attached to the purchase or refinance of that building, and not personally. So, definitely advantage when somebody's looking at creating a portfolio and limiting the amount of risk that you would have when holding that portfolio, just from a personal liability standpoint. Something cool that most people don't know. Now, in regards to disadvantages, security and benefit come with a price, and though one could certainly be made up for CMHC, the CMHC premium on the purchase of a multifamily property runs around 4.5% on an 85% finance product. So, it's really important to understand that you are getting a really great rate, but you are eating a huge fee. And if you factor in the idea that most large multifamilies are $1 million plus, at 1%, 1%, that's $40,000, So, I mean, if you're looking at $1 million, $2 million building, you're eating a decent chunk on a fee to insure the property, which is something that most people don't consider when they're looking to get the property. Oh, here we go, Amanda. So can the refinance money be used to buy a property in a different holding company, like a new numbered company? It's a good question. Yeah, I don't think it's specific to the numbered company that the building is in, as long as you can show a proof of ownership. If the holding company had other directors that were 20% and greater for shareholder, they'd want them to be on the application and vetted. But as long as you can show what those funds are going towards, then I don't think they have any problems with it being done in holding companies. And I'm pretty sure we've had that happen in the past. That wouldn't be an issue. Yeah, we had another question come in from Christian Sachs here. Said, have you heard of any lenders and how they are going to be looking at the CERB or the CRB? I believe from what we've heard is it's going to be seen as almost EI, and EI cannot be used as income. So if you do have the CERB and you are looking to use it as income on a mortgage application, unfortunately, you're not going to be able to use it. Yeah. And then something else, actually, just to kind of feed off of that, one thing that lenders will ask if you're purchasing commercial is whether or not the commercial tenants have received any of the rent, like that $40,000 program, and then any rent relief. They will want to know, just like I said, what they've received, whether they're still paying, and whether they've missed any payments. So if you are purchasing a building and it's either wholesale or you're looking at the building yourself, just make sure you ask that question. Just for a history of the repayment from the tenants and what they've received, what they haven't. whether they've missed any payments, whether they're on any payment assistance type programs. We will need to know that, and the lender will want to know those as well.
Yeah, so touching on uninsured mortgage products, essentially anything from a private product all the way up to a conventional product. There are a handful of advantages of taking on this specific type of mortgage compared to CMHC insured mortgages, one being less restrictive on ETO takeout. So anybody who's looking to be a little bit flexible, CMHC, as Aaron said, does have a specific lender list that they can refinance out of if you have a private loan. A conventional lender is going to be able to pull that equity out and take over the loan, but CMHC may not be able to. Faster turnaround time. There isn't as long of an application process. There isn't as much per unit cost as well when you're applying to CMHC, in reflection to applying to CMHC, I guess. There's no application fee, and the DSCR is decently flexible, depending on what type of capital stack you're looking to use to purchase the property. These uninsured mortgage products are specifically used for people who are trying to repurpose a larger multifamily, and then that's kind of like acquisition financing. So depending on how the asset debt services, you're going to use this type of financing to be able to acquire and then do your renovations, raise the rent, increase the NOI, and then at some point, once it hits a certain level, you're going to refi out with CMHC.
Yeah, some of the disadvantages of uninsured financing, the rates are a little bit higher, so it does eat into your cash flow a little bit. You're uninsured, you can get uninsured rates as low as 2.5, 2.3. But most of them are probably going to be in between that 3 to 4% on the uninsured side, depending on the borrower's strength, what their what your net worth takes a look like, and what the building's debt servicing looks like, and how strong it's performing. Lower loan to values, you don't get that option for 85% loan to value with an uninsured. Your maximum loan to value is 75%. And then your total NOI is affected because that loan amount is higher, and the amortization is higher. So credit unions themselves specifically are limited to a 20 or 25-year amortization. So they don't have that option for 30 or 35. There are some other banks out there like National Bank who does have the ability to do a 30 or 35. And I think Equitable is the exact same way. They can do a 30 or 35-year amortization. So some of those lenders on the initial acquisition are really strong partners to be able to use for repositioning loans. Basically, when a building is not debt servicing 1.2, 1.25, and it's sub 1.15, there are some credit unions who can do 1.15, but anything below that, you're looking at one of these repositioning type products where the lender is able to do 1.1, maybe 1% to that 1.1% area. And they're able to get to that debt servicing by a couple of things. One, they move to an interest only type loan. So you'd be looking at like a 5% interest only loan instead of 3.5% amortized loan. And then they also drop the loan to value. So they can do a 65% loan to value, and the combination of those two details actually helps to increase the debt servicing ratio because you're taking a less loan. So your loan amount is going to be less and your monthly payments going to be less. And then you're only looking at an interest portion, which again helps to decrease your monthly payment. So it helps to boost up those DSCR ratios when they're not quite there at a traditional lender.
Which is much better than obviously going on the private route and taking on all the fees. So what we want to do is we had a handful of questions or top questions for the CMHC financing. So we just wanted to run through them with you guys. Amanda, do you have any lenders willing to do higher loan to value on refinance than 75%? I have not found anybody that is willing to do higher LTV, not unless you want to cross collateralize an asset and then decrease the overall loan to value of a property to pull the cash out. Specifically on a multifamily commercial property, I haven't found anybody that'll go over 75.
Yeah, I have noticed that there are some banks who are taking a look at the 5 to 6 unit area. 5 to 6 units, there are lenders out there who can do it as residential, in which case you might get 80% loan to value. And I've had a couple deals where it was a 8-unit building, and there are some lenders who will look at it residentially. So they're, depending on the performance of that building, they might be able to do 80%. But anything larger than that, like a 10 unit plus, you're really stuck at a 75% loan to value.
Yeah, so top question, what constitutes permitted use of funds for a CMHC refinance? Number one, to discharge the outstanding balance of an existing mortgage financing on the subject property. The second is going to be to secure a permanent financing on the subject property, so takeout financing, essentially the first point. To undertake capital repairs, improvements on the subject property, and to purchase other existing multifamily rental properties, 2 units or more, and to undertake capital repairs, improvements to other existing residential properties in your portfolio, and to construct new residential rental properties, 2 units and up.
And then the second question again, which we kind of touched on, but is there a certain time frame that you have to have, planned out for to be able to utilize the equity takeout? The short answer is no. They don't have a given timeline. They really depend on the qualifying lender to be responsible to make sure that everything is following CMHC guidelines. Every lender is relatively different and unique. So, for example, like First National, they kind of have their own loan requirements that they'll do CMHC for. So like their minimum loan amount is $1 million, where there are other lenders who will deal with loan amounts under that $1 million area. So again, like in terms of the timeline, each lender has their own given timeline that they want to see. So you might see a little bit of variance, but in terms of a purchase, they're going to want to see that you have a purchase and sale agreement in hand, or show that you're going to have it in hand in the next month, and that you're pretty much ready to go that way on the purchase. In terms of any constructions or renovations that you're looking to do, they're going to want to see some sort of budget and plans in hand, drawings, cost outline. Do you have your cost consultancy reports done? Do you have your GC in hand? Like, do you have all these things laid out, or are you just, fresh in the process with the city if it's a build, or, fresh in the process with the renovation? So just making sure you're ready to go and to get that financing on hand. And then the next step is you're starting the renovations or the construction. They're not going to want to see a huge gap in between time of funds given and the start of a project.
Yeah.
And then, using those funds obviously for acquisitions and constructions or refinances. Everything is geared towards multifamily. They want it to be pushed towards multifamily financing.
Yeah, guys. So, I mean, as you can see, there are a handful of different options. You can go into CMHC right away if you're buying like a perfectly cash flowing, already set market rent building. That makes sense. I mean, if that's your strategy, I mean, if you're a REIT and you're looking for perfectly cash flowing buildings, then do it. For most of the investors who are looking to actually create capital, that isn't quite what we're looking at. But in general, there are a handful of options available to you in the multifamily space. I know we touched on it a little bit in the previous weeks, but there are ways to use like cross collateral as cash equity position for down payments. There are ways to be able to structure VTBs in a way behind conventional first mortgages with institutional lenders to be able to maybe not take on a private loan, but take on some sort of low carrying cost regular loan to get into the property. It's a handful of different ways in which you can utilize the multifamily financing space.
Yeah, I think one thing to kind of consider too, and I'm dealing with this on a specific client, the building is underperforming. They went firm without really taking a look at the numbers, and the numbers just didn't come out in the debt servicing very well. Most of the feedback from the lenders has been around 65% loan to value. In a $1.5 million building, that puts the down payment around like 525, I think it was, or it's up like that 500,000 area. For the clients themselves, that was a pretty large chunk of change, and they weren't quite expecting that 35% down payment. Sometimes in those situations, it is cheaper to take a look at a private mortgage where the lender is going to be not so dependent on the debt servicing ratio being at 1.2. As long as there's a set NOI coming in, they might still be at 75% loan to value. In this case, it is actually cheaper for them to go 75% loan to value with a private, and pay all the fees and come out with still some more, still having money in their pocket left for any of the renovations. Now, in those cases, and especially right now with the eviction freeze on, it does limit what your exit strategy is going to be. Obviously, you can't go into a building and evict the tenants right now. So, if you were looking to do some sort of cash for keys type thing, that's really your only option to get any tenants out right now. How does that play in? Well, if your ability to get into a lender on a refinance is subject to the rent coming in and your debt servicing, if you can't get those tenants out and raise the rents, you don't really have an exit strategy to get out of the building. So that's something to kind of keep in mind and making sure you take a look at the numbers first, especially on the commercial buildings. We know the offer's hot or the market's hot right now, and there are a lot of people going in with like clean or unconditional offers. We obviously don't recommend that, but doing the due diligence first and taking a look at the numbers and making sure that building debt services. And if it doesn't, what are your options? Just because, like I said, being able to turn over the tenants right now is quite difficult with the eviction freeze. So getting creative on the commercial stuff right now is difficult if there are tenants. If it's vacant, that's a much different story because then you can go in and refill those tenants. But if it is tenanted and it's underperforming, it does make it a little bit more complicated to go private and then be able to refinance out.
For sure. And I think that wraps up for our CMHC financing episode today. I don't think we're just going to cut it short. It is Valentine's Day. We obviously forgot that it was Valentine's Day and we had this in the same day. But, we thank everybody who came on here today. Always good chatting with you guys. Make sure if you don't already, hit the subscribe button if you're on YouTube. It really help us out. Hit the like button and we will be back next week.
Yeah.
See you guys.